Welcome back, everybody. Today we're talking about getting smarter with our money.
Becoming intelligent investors.
Yeah, becoming intelligent investors. And we're digging into a classic for this one.
Oh, yeah, a classic.
The Intelligent Investor by Benjamin Graham.
Timeless.
Now, this book, it's been around for decades, but it's still so relevant today.
Especially
with all the wild market swings we've seen lately, right? I mean,
oh, absolutely.
Oh.
I mean, the principles in this book, they're like financial bedrock.
Yeah.
It's like having this solid foundation for navigating all the craziness.
It is. And we've got Jason Zweig's commentary to guide us along the way, too.
Oh, his insights are invaluable. He really connects those timeless principles to today's market.
Yeah, he does. He does. So let's dive in. What is it about this book that makes it so special? I mean, why are we still talking about it after all these years?
Well, it's not just about crunching numbers and memorizing formulas.
Right.
It's really about developing the right mindset for investing.
Mindset, yeah.
Yeah, that's what Graham calls having the intelligent investor mentality.
So it's not about needing a genius IQ.
No, not at all.
Yeah.
It's more about temperament.
Temperament, okay.
Yeah, being patient, disciplined.
Right.
Not letting your emotions control your decisions.
That's huge.
Oh, absolutely.
Yeah.
Because, the market, it can be like a roller coaster. Sometimes.
It is. It really is.
It's so easy to get caught up in the hype and make impulsive moves.
And Graham, he really contrasts this intelligent investor approach with what he calls
the speculative frenzy.
Yeah, the speculative frenzy. And I think we've all seen that play out, right?
Oh, yeah. Think back to the dot-com bubble in the late 90s.
Oh, man.
You had companies like VA Linux with valuations that were
sky
high, but they were losing tons of money.
It was pure hype.
Pure hype.
And Zweig brings up a great modern example, too. He talks about Cisco Systems.
Oh, yeah. It's
a tech giant during the dot-com boom.
Everyone thought they could do no wrong.
Right. But then, boom, crashed hard, lost 76% of its value?
Ouch.
Yeah, ouch. That really shows how quickly things can change when hype drives the market.
It's a cautionary tale for sure.
It is. So how do we tell the difference between actually investing and just speculating?
Well, Graham has this fantastic analogy.
Yeah, okay, I love analogies.
He compares investing to a unique casino where you actually can't lose if you play by the rules.
Okay, that sounds like my kind of casino.
Right.
So what are the rules? What rules are we talking about here?
Well, it's all about focusing on a company's true value.
Okay.
Aiming for those long-term returns.
Long-term.
Yeah, not those quick flips.
Got it.
You're tilting the odds in your favor when you focus on the fundamentals.
Fundamentals. That makes sense. Now, this is where it gets interesting. Graham actually calls out a popular stock-picking formula.
The foolish four.
The foolish four. Okay, and why does he call it foolish?
Well, it basically told people to put most of their money into just a handful of stocks.
Oh, no diversification.
Ignoring diversification.
Yeah.
And guess what?
What?
It failed miserably.
Miserably, okay.
It was a classic example of trying to time the market and get rich quick.
Right, because past performance doesn't guarantee future results.
Exactly. It's like assuming you'll win the lottery just because your neighbor did last week.
So diversification is key.
Absolutely. Spread your risks.
Spread the risk. Okay, so how does a savvy investor, and I like that term, savvy investor.
I like that too.
How does a savvy investor actually build a portfolio?
Well, Graham lays out two main approaches.
Okay.
The defensive investor and the enterprising investor.
Okay. Two different personalities, two different approaches. Let's start with the defensive investor.
All right. The defensive investor is all about minimizing risk.
Okay. Minimizing risk.
Simplifying their choices. Aiming for steady, satisfactory returns.
Steady and satisfactory. Not shooting for the moon.
Not necessarily. They're more focused on protecting their capital.
Okay, makes sense. And what kind of asset allocation does Graham suggest for the defensive investor?
Well, he recommends the classic 50% stocks, 50% bonds split.
50-50? Okay.
Yeah. He believes that owning stocks is crucial, even when times are uncertain.
Even when things are looking a little scary.
Exactly. Because over the long term, stocks have historically outperformed other asset classes.
So we've got our 50% stocks.
Yeah.
How do we go about building that portion of the portfolio?
Well, Graham is a big fan of dollar cost averaging.
Dollar cost averaging. Okay, I've heard of that, but I'm not sure I totally get it.
It's a simple but powerful technique.
Okay.
You invest the same amount of money regularly.
Okay.
No matter what the market is doing.
So if the market's up,
you buy.
If the market's down,
you buy.
You buy. Okay, so you're averaging out your purchase price over time.
Exactly. You're taking the emotion out of it
I like that.
And you're avoiding trying to time the market.
Which is impossible anyway, right?
Pretty much.
Yeah.
And you know what else Graham suggests?
What's that?
Exploring index funds.
Index funds. Okay, those are becoming pretty popular.
Oh, yeah. They're a great way to get instant diversification.
So you don't have to spend all your time researching individual stocks.
Exactly. You just buy a basket of stocks that tracks a specific market index, like the S&P 500.
Easy peasy. Okay, so we've talked about the defensive investor, the more cautious approach. What about those who want to be a little more hands-on? What does Graham suggest for the enterprising investor?
The enterprising investor.
Yeah.
They're a different breed.
Okay, tell me more.
They're willing to put in the time and effort to potentially uncover higher returns.
So they're doing their homework.
Oh, yeah. They're digging deep.
Okay.
But they're still grounded in the principles of value investing.
Value investing. Okay, so they're not just chasing the latest hot stock.
No, they're looking for those hidden gems.
Hidden gems. I like it. Now, one way they might do this is by focusing on growth stocks, right?
Growth stocks, exactly. Those
Fine.
companies with high growth potential.
But I imagine there's more to it than just chasing the latest fad.
Oh, absolutely.
Okay.
Graham warns against blindly chasing those high-flying growth stocks.
Especially those with sky-high valuations.
Especially those, yeah, because sometimes those valuations,
Yeah.
they're based more on hype than solid fundamentals.
Hype, we've talked about that before.
It could be dangerous.
Yeah.
He emphasizes thorough research.
Research.
Yeah, understanding the business.
Okay, so it's not just about looking at the stock price.
Not at all. You need to dig into the company's financials, their management team, their competitive landscape.
Their moat.
Exactly, their moat.
I love that analogy. Now, he uses a great example to illustrate this point. He talks about Texas Instruments.
Texas Instruments.
Back in the day, its stock price was soaring.
Oh, yeah. Everyone wanted a piece of that action.
But it was growing way faster than its actual profits.
Oh.
Yeah. Oh, and 2 years later.
Earnings crash took the stock down with it.
Oof. So even seemingly unstoppable growth can come to a screeching halt.
It can, and it often does.
Especially if it's not backed by solid fundamentals.
Fundamentals are key.
So it's not just about growth. It's about sustainable, profitable growth.
Precisely. And, Zweig adds another great example here. He talks about WorldCom.
WorldCom. Oh, yeah, I remember that one vaguely.
This was another high flyer during the dot-com bubble.
Okay.
Stock was soaring.
Right.
But behind the scenes, they were basically cooking the books.
Oh, no.
Yeah, not good. And when the truth came out...
What happened?
Spectacular crash.
Another cautionary tale.
Oh, yeah. Big time.
So how does a savvy investor approach growth stocks without getting burned?
That's the million-dollar question.
It is. It really is.
It all comes down to looking beyond the hype and really digging into a company's fundamentals. Look for companies with a track record of solid growth, strong management, a real edge that can help them thrive in the long run.
It's about being discerning, not just jumping on the bandwagon.
Right. Exactly.
So we've talked about the defensive investor and kind of dipped our toes into the enterprising investor. What other nuggets of wisdom does Graham offer in this treasure trove of a book?
Well, he dives into real-world examples. He looks at the rise and fall of companies like Chrysler.
Chrysler.
Okay. And he shows how even these giants can stumble.
They can stumble.
Oh, yeah. Especially if they lose sight of the bigger picture. It's a cautionary tale about understanding the underlying dynamics of a business.
It's not just about the numbers on a spreadsheet.
Not just the numbers.
Yeah.
You got to look beyond that.
It's almost like he's saying, look for those companies that are quietly building value, not just making headlines.
Exactly. He's a big advocate for a long-term, value-oriented approach to investing.
Now, something that really struck me while reading this book was Graham's emphasis on independent thinking.
Oh, yeah.
It's like, don't just follow the herd, think for yourself.
That's huge.
And honestly, that's so refreshing in today's world where, everyone's trying to sell you the next big thing.
Absolutely. He stresses the importance of developing your own judgment, not blindly following experts or market trends.
Because even the experts can be wrong.
Oh, they can be spectacularly wrong. Remember when everyone thought the housing market would never go down?
Ouch. Yeah, I remember that one.
That's why the intelligent investor is so valuable. It gives you a framework for thinking about investing, a set of principles to help you cut through the noise.
And make your own decisions.
Exactly. You're empowered.
Now, one thing I found particularly interesting was how Graham really dives into the psychological side of investing.
Well, yeah, the mental game.
Yeah, he talks about how our emotions can lead us to make really bad decisions, both when buying and selling.
Fear and greed.
Yeah.
They can really mess with your head.
They can. And he warns against getting swept up in market euphoria or, panicking when things go down.
It's like riding a roller coaster. You got to hold on tight and not jump out at the first drop.
And he even offers some practical tips for managing those emotional swings, right?
He does. He does.
Yeah.
It's about recognizing those emotions, understanding their impact, and developing strategies to stay grounded.
So, for example, treating stock price fluctuations as opportunities to buy low and sell high rather than, a sign to panic and sell everything.
Exactly. It's about taking advantage of those moments when the market is being overly pessimistic or optimistic.
He also talks about the importance of patience.
Oh, yeah. Patience is key.
Real investors, they're in it for the long game.
They're not chasing quick profits.
They're building wealth over time.
They're focused on sustainable growth.
Okay, now I know this book is a classic, but I'm curious, how does Zweig's commentary add to it, especially for those of us navigating today's market?
Well, he does a fantastic job of connecting Graham's timeless principles to the modern investing landscape.
Okay, give me an example.
Well, for example, he talks about index funds.
Index funds.
Yeah, which become a really powerful tool for passive investing.
Right. And those weren't as readily available in Graham's time?
Not at all.
And with index funds, you don't have to spend hours picking individual stocks.
Nope. You just track the market, keep your costs low.
Simple yet effective.
Exactly.
Now, he also addresses the challenges of investing in today's information overload.
Oh, yeah, we're bombarded with information 24/7.
It's easy to get overwhelmed and react impulsively.
Absolutely. He provides practical advice on how to stay grounded and disciplined even when the market is going haywire.
So important.
Oh, yeah. Tuning out the noise. Focusing on your own goals and strategy.
Something that really resonated with me was Zweig's emphasis on that tuning out the noise and focusing on your own goals.
He says, don't let the internet seduce you into becoming a speculator.
So true, right? It's so easy to get caught up in the frenzy.
It is. You got to be intentional about your approach.
Now, Graham, he doesn't just focus on stocks. He also talks about bonds, right?
He does. He does bonds.
Yeah.
They can provide stability and income.
Especially for those with a lower risk tolerance.
Exactly. They're often seen as the boring part of a portfolio.
The boring but important part.
The boring but important part.
Especially as we get closer to retirement.
Exactly. And he also gets into managing taxes.
Taxes.
I know, but it's crucial for maximizing your returns over time.
Because taxes can really eat into your profits.
Oh, they can, big time.
It's like working hard all year only to have a big chunk of your earnings disappear come tax season.
That's a great way to put it. And Zweig adds to this by discussing the importance of tax efficiency.
Tax efficiency, okay.
Yeah, choosing investments that minimize your tax burden.
So like being strategic about which types of accounts you use.
Exactly. Taxable brokerage accounts versus tax-advantaged retirement accounts.
It's about making your money work smarter, not harder.
I like that.
Okay, now I know not everyone wants to pick their own stocks. Some people prefer to let the experts handle it.
Right.
So what does Graham say about investment funds?
He dives into the world of mutual funds, offers guidance on choosing funds that are aligned with your goals and risk tolerance.
Okay.
He talks about understanding a fund's investment strategy, its track record, its fees, because high fees can really hurt your returns over time.
It's like paying a hefty commission on every trade.
It is. Over time, those fees can really add up.
They can. And he also explains the difference between open-end and closed-end funds, right?
He gives insights into their unique features.
So he's really covering all the bases here.
He is.
Now, one of Graham's key recommendations for fund investors is to focus on low-cost index funds.
Index funds again.
Yeah, he loves those index funds.
They're a simple way to capture broad market returns without the hassle of active stock picking.
They're like the set it and forget it option of the investing world.
Exactly.
You're essentially betting on the overall market, which historically has trended upwards over the long term.
It has.
Yeah.
It has. And Zweig backs this up by highlighting the impressive track record of index funds.
Okay.
He points out that most actively managed funds, they actually underperform their benchmark indexes.
Really?
Yeah, because of those high fees.
So sometimes simplicity and low costs can trump complexity and high fees.
Often they do.
Now, one thing I really appreciated was Graham's emphasis on finding trustworthy advisors.
Oh, yeah. Advisors are key.
Yeah, he dedicates an entire chapter to this topic.
It's so important.
It is. It really is. Because not all advisors are created equal.
Yes. Not at all. He provides practical advice on how to evaluate potential advisors and avoid those who might not have your best interests in mind.
So like red flags to watch out for.
Exactly.
And he stresses the importance of understanding their qualifications, their fees, and their potential conflicts of interest.
Transparency is key.
It's like choosing a doctor or a lawyer.
It is. You want someone who's experienced, ethical, and genuinely cares about your well-being.
Right.
He even gives you a list of tough questions to ask potential advisors.
Oh, I like that.
It's about being proactive and making sure they're truly committed to your financial success.
Now, Graham doesn't just focus on the big picture. He gets into the nitty-gritty of analyzing individual securities,
He does. He does.
which can feel a bit intimidating for the average investor.
It can,
Mm-hmm.
but he breaks it down into manageable steps.
Okay, so he explains the basic principles of evaluating a company's financial health.
Exactly. He looks at their earnings, their debt levels, their asset values.
Provides a framework for understanding those financial statements.
He does. He does. He even gets into specific ratios and benchmarks.
Okay, I'll admit some of that stuff went over my head.
It can get pretty technical.
It can. But what I got from it was that he's really emphasizing the importance of understanding what a company is actually worth.
Intrinsic value.
Intrinsic value, not just what the market says it's worth.
That's right. The market can be irrational.
It can be very
You
irrational.
got to look beyond the hype, dig into the details.
Now, to bring these analytical concepts to life, he uses a series of case studies.
Oh yeah, the case studies are great.
They are. It's one thing to hear about the theory, but it's another to see it applied to real companies.
Absolutely. He compares and contrasts companies based on various financial metrics.
Shows how market perceptions and investor sentiment can impact a company's stock price, even if their underlying businesses are quite similar.
It's fascinating to see how different investors can view the same company in completely different ways.
And how those different views can lead to wildly different valuations.
Exactly. Now, one of Graham's key insights is to be wary of companies that rely too heavily on acquisitions to grow.
Acquisitions, okay.
Yeah, he calls these serial acquirers,
Serial acquirers.
and he cautions that acquisitions can be risky.
They don't always deliver the promised benefits.
Not always.
Yeah.
It's like someone who keeps buying new gadgets but doesn't actually know how to use them.
They might look impressive on the surface, but they're not creating any real value.
Exactly.
Oh.
And Zweig brings this into the modern context with examples like Tyco International.
Waco. Okay.
That we went on a crazy acquisition spree, but it ultimately backfired.
Led to a collapse in their stock price.
It did. It's a reminder that sustainable growth, it often comes from within, from building a strong core business, not just from gobbling up other companies.
So build from within.
Build from within.
Okay. Now, Graham also emphasizes the importance of understanding per-share earnings.
Earnings per share.
It's a commonly used metric to assess a company's profitability.
It is. It's.
But he warns that it can be manipulated.
Oh yeah, through accounting tricks.
Accounting tricks, so we need to be careful.
Be very careful. He encourages looking beyond the headline numbers and really understanding the accounting practices behind them.
It's like being a detective looking for clues to uncover the truth.
I love that analogy.
Now, Graham goes even deeper by comparing 8 pairs of companies in another chapter.
Oh yeah, this is a great chapter.
It is. He analyzes them using different financial metrics and highlights how seemingly similar companies can have wildly different valuations.
It's all about understanding the nuances.
It's the nuances.
Yeah. He even compares companies with similar names, like McGraw-Edison and McGraw-Hill,
Okay.
pointing out that despite their similar monikers, their businesses and financial performance can be worlds apart.
It's a reminder that you can't judge a book by its cover.
Yeah.
Or a company by its name.
Exactly. You got to look under the hood.
Now, one of Graham's key points in this chapter is that investors should be wary of companies with excessive goodwill on their balance sheets.
Goodwill.
Yeah, goodwill is essentially the premium paid for an acquisition above the fair market value of its assets.
It's like paying extra for the brand name or the potential of a company.
So it's like buying a house for way more than it's worth just because it has a fancy name.
That's a great way to put it. And Graham cautions that large amounts of goodwill can be a red flag.
Especially if the company has overpaid for acquisitions.
Especially then. It can lead to future write-offs and hurt earnings.
So it's a potential warning sign.
It is. It is.
Now, another fascinating comparison Graham makes is between Cisco Systems and Cisco Corporation.
Cisco and Cisco. Okay.
Yeah, these were both high-flying companies in the late 90s.
The dot-com darlings.
But Cisco, the tech darling, traded at a whopping 134 times its earnings.
Wow.
While Cisco, a food distribution company, traded at a much more modest 24 times earnings.
That's a huge difference.
It is. It is.
And yet both companies had impressive growth rates and strong financials.
Okay.
Graham even delves into their cash flow statements. Yeah, pointing out that Cisco was actually generating significantly more cash from its operations than Cisco.
Interesting. So it's a classic example of how market sentiment and investor psychology can drive these huge valuation gaps.
Even between companies with similar financial performance.
It's like One company is the trendy fashion brand everyone's talking about, while the other is the reliable workhorse that quietly gets the job done.
That's a great analogy. And this leads to one of Graham's most important points.
What's that?
The difference between a company's intrinsic value and its market price.
Okay. Intrinsic value versus market price. Break that down for me.
So intrinsic value is like the true worth of a company,
Okay.
while market price is just what people are willing to pay for it at any given moment.
Got it. So the market can be irrational,
Oh, it can be wildly irrational in the short term.
driven by emotion, speculation, herd mentality,
All of that.
all of that. So Graham encourages investors to focus on a company's long-term earning power, its assets, its dividends.
Rather than getting caught up in those day-to-day stock price swings,
So tune out the noise.
tune out the noise.
Yeah.
Focus on the substance.
The substance. Okay, that makes sense.
He provides a framework for calculating a company's intrinsic value. But even Graham admits it's not an exact science.
It's more of an art than a science.
Exactly. It requires judgment experience.
It's like trying to figure out what a used car is really worth. You can check the Kelley Blue Book, but you also need to consider the car's condition mileage, any other factors that might affect its value.
Right. You got to look beyond the numbers.
So it's not just about crunching numbers.
Not at all. It's about understanding the business, the industry, the management team.
And speaking of management, Graham really dives into the human side of investing.
Oh, yeah. He emphasizes the importance of understanding management's actions, their motivations.
Because after all, companies are run by people,
They are.
and people don't always act rationally or in the best interests of others.
That's true. He dedicates a whole chapter to the relationship between shareholders and management,
Okay.
exploring the potential conflicts of interest that can arise.
Conflicts of interest. So he's saying that managers don't always act in the best interests of shareholders.
That's right. Especially when their compensation is tied to short-term stock performance.
Oh, so it's like a salesperson who's more focused on hitting their monthly quota than on building long-term relationships with customers?
Exactly. They might be tempted to make a quick sale, even if it's not the best solution for the customer in the long run.
Right. Short-term thinking.
Short-term thinking. He uses the example of stock options.
Stock options.
Yeah, they can incentivize managers to prioritize boosting the stock price, even if it means sacrificing long-term value creation.
So it's all about incentives.
Incentives matter. He talks about NVF company.
NVF. Okay.
Yeah, where management got caught up in some shady accounting practices and stock manipulation schemes.
Oh, yeah.
Yeah, benefited them, but potentially harmed shareholders.
So it's a reminder that while we want to believe that everyone's acting ethically, there's always the potential for conflicts of interest.
Always. And Zweig brings this into the modern era with the Enron scandal.
Enron. Oh, yeah, that was a big one.
It was a classic example of how corporate greed and a lack of transparency can have disastrous consequences.
They built that complex web of off-balance sheet partnerships, right?
They did, all driven by conflicts of interest.
And it ultimately led to the company's collapse.
It did. It's a sobering reminder that we can't just blindly trust management.
We need to do our homework.
Absolutely. Understand what's really going on behind the scenes.
Be skeptical.
Be skeptical. Now, Graham, he also challenges conventional wisdom on dividend policy.
Given policy. Okay.
He argues that companies should prioritize paying dividends over reinvesting earnings, especially if they're not outperforming the market.
Wait, really? Isn't the common advice to reinvest earnings for growth? Especially when you're younger and have a longer time horizon.
That's the usual thinking. But Graham argues that dividends can be a valuable source of income for shareholders.
Okay.
And companies have a burden of proof to show that shareholders are better off if they don't pay dividends.
So it's like if you have a rental property that's generating steady income, you could reinvest that income to buy more properties, or you could use it to pay yourself a dividend and enjoy the fruits of your investment.
That's a great analogy. It's about striking a balance
Balance.
between reinvesting for growth and rewarding shareholders for their investment.
And Zweig adds a modern twist to this discussion.
He does?
He talks about stock buybacks.
Stock buybacks.
Yeah, they can benefit shareholders, but they can also be used by management to manipulate earnings per share and increase their own compensation.
It's another reminder that investors need to be aware of management's motivations.
Make sure their actions align with shareholder interests.
Absolutely.
Yeah.
Okay, now Graham circles back to his core concept in the final chapter,
Okay.
margin of safety.
Margin of safety. He calls this the cornerstone of intelligent investing.
It is.
But I'll admit I struggled a bit to grasp its practical application.
Okay, well, think of it like this. Imagine you're building a bridge. You wouldn't just design it to hold the exact weight it needs to support, right?
No, you'd build in some extra strength
Exactly. You'd build in a margin of safety.
to account for unexpected loads, wind gusts, maybe even earthquakes.
Exactly.
Yeah.
You're over-engineering it to handle more than it's expected to, just in case something unexpected happens.
Okay, so you're being cautious.
Cautious. That's what a margin of safety is all about.
So in investing, it means buying assets for significantly less than they're worth,
Exact.
creating a cushion for error, unexpected events.
A buffer.
A buffer. I like that. So if a company is truly worth $100 per share, a savvy investor would aim to buy it for significantly less
Maybe $70 or $80 per share.
to provide that margin of safety.
That cushion helps protect you from the uncertainties of the market and the limitations of human judgment.
So it's like having a financial safety net.
It is. And the larger the margin of safety, the lower your risk and potentially higher your returns.
Makes sense. Now, Zweig adds to this by highlighting the limitations of traditional risk measures like beta,
Beta.
which just looks at a stock's volatility.
Volatility, how much the price jumps up and down. He argues that a low beta stock can still be risky if it's overvalued.
Okay.
And a high beta stock can actually offer a margin of safety if it's trading at a deep discount.
So it's not just about volatility.
Not just volatility, you got to consider the price you're paying relative to the company's intrinsic value.
It's like comparing a flashy sports car to a reliable pickup truck.
Okay.
The sports car might be exciting and grab attention,
Yeah.
but the pickup truck is more likely to get you through tough terrain.
I like that analogy.
Hmm.
Now, to really drive home the principles of intelligent investing, Graham includes some fantastic appendices.
Appendices.
One standout is The Super Investors of Graham and Doddsville.
The super investors.
Okay, he profiles 9 successful investors who consistently beat the market by applying his value investing principles.
It's like showcasing the all-star team of value investing.
Exactly. And these super investors come from diverse backgrounds. They have different styles,
Yeah.
but they share a common mindset.
Oh, okay, what's in that mindset?
They focus on buying businesses, not stocks.
Business is not stocks.
And they look for undervalued opportunities where they can get more than their money's worth.
It's like finding those hidden gems at a flea market, except these gems are companies.
Exactly. He uses these real-world examples to show the power of patience, discipline, and independent thinking,
So it's a testament to the enduring relevance of value investing.
even in today's crazy market.
Now, as we wrap up this deep dive into the intelligent investor, what are some key takeaways for our listeners?
Well, I think the biggest takeaway is that becoming a savvy investor is a journey, not a destination.
A journey. Okay.
It's about cultivating the right mindset, developing your analytical skills, and staying true to those core principles of value investing.
So the intelligent investor is like a roadmap for that journey.
It is.
Yeah.
It's about navigating the complexities of the market, understanding the psychology of investing, and most importantly, learning from the mistakes of others.
Learning from the mistakes of others, that's huge.
It is. It's about becoming a student of the market, constantly learning and adapting as you go.
So don't be afraid to make mistakes.
Don't be afraid. Just learn from them.
Learn from them. Take the time to read and reread Graham's work.
And explore Zweig's insightful commentary.
Apply those principles to your unique investment goals.
Remember, with patience, discipline, and a commitment to learning, anyone can become a more intelligent investor.
And as you go on this investing journey, ask yourself this. How can you apply these principles of value investing not just to your finances, but to other areas of your life?
How can you seek out those undervalued opportunities in your career, your relationships, your personal growth?
That's a great question.
It's about recognizing that the principles of intelligent investing, they're not just about maximizing returns.
They're about making wise decisions.
They create lasting value in all aspects of your life.
So it's about being a thoughtful decision maker, always seeking value, looking beyond the hype
That's the essence of being an intelligent investor.
in your portfolio and in your life.
Exactly. Thanks for joining us on this deep dive into the intelligent investor.
We'll see you next time on The Deep Dive.